Hello dear traders. The year started with highly volatile movements and the second trading week was as exciting as the first. Discussions and speculations about the prospects of changes in the monetary policy of the Federal Reserve did not subside, especially in anticipation of news on consumer inflation in the US. The initially expected date for a rate cut by the American Central Bank was pushed closer to summer, but after the publication of production inflation data on Friday, investors returned to the idea that monetary easing will start during the March Fed meeting. Let's discuss how the value of the US dollar and other key currencies and commodities changed during the past week. The US dollar index, demonstrating the position of the dollar against a basket of 6 other major currencies, returned to the levels at which the week started, around 102.50, despite sharp fluctuations. Macroeconomic reports and comments from members of the Federal Reserve Open Market Committee influenced investor sentiment. For example, Loretta Mester, the president of the Federal Reserve Bank of Cleveland, stated that it is too early to consider a rate cut. Meanwhile, her colleague from Richmond, Thomas Barkin, expressed doubts about the inflation data assessment. Against this backdrop, the euro remained around the level of 1.0950 against the US dollar. The European Central Bank representatives also influenced trader sentiments. ECB President Christine Lagarde stated on Thursday that the worst is likely behind in terms of inflation, emphasizing that interest rates will be lowered if inflation falls to 2%. Traders are likely waiting for the final assessment of December's consumer price growth, and for now, the euro-dollar quote remained in the same sideways range. The British pound managed to strengthen slightly over the past week. The quote rose to the highest level since December 27th, thanks to a positive macroeconomic background. Data on the UK economic growth for November, showing a 0.3% increase in GDP for the month, contributed to the positive sentiment. However, the dynamics in the manufacturing sector remained negative. Regarding the central bank's rhetoric, the governor of the Bank of England told the UK Parliament that consumers and the UK economy were not in such constrained position as during the financial crisis. Investors perceived this statement as a hawkish signal. Meanwhile, in Japan, the central bank maintains a dovish stance. The dollar-yen pair continues to rise, reaching 145 yen per dollar. Traders are gearing up for the release of inflation data in Japan this week. Analysts anticipate a slowdown in the pace of price growth, but the central bank is unlikely to raise rates. Japanese monetary officials insist on the need to ensure sustainable inflation growth at a 2% annual rate, supported by wage increases. Gold closed last week with a sharp rise, displaying increased volatility due to several factors influencing the trading instrument. Trader sentiments continue to be shaped by speculations regarding the potential change in the Fed's interest rate. Following the release of U.S. production inflation data, investors returned to selling the US dollar, assuming that the U.S. Central Bank would indeed initiate a rate cut. Simultaneously, they turned to gold as an alternative asset with more promising returns than U.S. Treasury bonds. Additionally, gold gained weight with a risk premium due to heightened geopolitical tensions in the Middle East. The US, in coalition with the UK, conducted multiple strikes on the Houthi targets in Yemen. Certainly, oil traders reacted to this escalation of the conflict in the Red Sea. Brent crude oil rose to $80 per barrel, but towards the end of Friday's trading, it declined to $78.50 per barrel. Concerns about supply disruption persist, and major shipping companies are forced to alter routes through southern Africa, leading to increased maritime transport rates. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!